Hi there, welcome to Market Call today on BNN Bloomberg. I'm Paul Bagnall. Gordon Reid is our guest today. Of course, he is President and Chief Executive Officer at Goodreid Investment Counsel and an expert in U.S. stocks. That is the subject matter on today's edition of Market Call. Our phone number is 1-855-326-6266. The email address, as always, is marketcall@bnnbloomberg.ca. So get your questions in right now to Gordon Reid, and we will, before too long, begin putting your questions to Gordon. Gordon, welcome to the show, as always.
Thank you, Paul.
So what is the key for investors to get through these markets?
Well, I think everybody's different, aren't they? You know, some of us can take these ups and downs with ease, and some are glued to the TV or the computer. And I think the overreaching lesson here is that hopefully investors came into this well prepared,
right,
well diversified, with asset mixes that suited their objectives, that their target levels were in place. At Goodreid, we spent the early part of the year, January and February, bringing asset levels back to their target levels. Of course, equities had run in 23 and 24, so any excesses over the target level we brought back to put us in good shape there. But now that we're in this, I think you basically let it play out. Let all the chapters be written. I've talked to a lot of clients and reminded them that we go through these events fairly often. If you think back to the pandemic of 5 years ago, Brexit of 2016, the 2008 financial crisis, 9/11, right, and I could go on. And I've kind of gently challenged people to say, how did you feel in the middle of that, as the markets were going straight down and without tomorrow's newspaper? And of course, that brings back the real true memories of fear and unknown, and wondering whether you should just take an exit. But the lesson, I think, is that 6 weeks ago, we hit an all-time high in the markets, which means that all of those past events were overcome.
Right.
And I think that's the lesson of this one.
Each down market is different, and this one is characterized by one single person wanting to upend the global trading order. Right. Your thoughts?
Well, I think his playbook is well known. His playbook is to use scare tactics, intimidation, in order to extract concessions, greater concessions than he might get otherwise. We saw that exact playbook in Canada just weeks ago, where he was talking about the 51st state and diminishing us as a nation. And you and I and everybody else saw how we reacted. What happened? Well, he backed off because he got some concessions and then he backed off. I think that playbook will likely play out with what he's done now with the rest of the world. But of course, I don't know. No one knows. And if you're well structured in your portfolio, should be okay.
We're almost out of time, but are you buying now? Are you using this big decline to buy?
If a client were to come to us with new money, or a new client were to come to us, yes, we'd be buying. We think that it will turn out to be a good buying opportunity, but we're not buying tactically. At Goodreid, we take a strategic approach. We're not market timers. We ride through these events, as uncomfortable as they are. We ride through them because we know that our business plan has accomplished its goals for our clients over the long term. So why mess with something that works by introducing an outside variable?
That's Gordon Reid, and those are his opening thoughts on another very interesting day in the market. We'll be back with Gordon, and then you will be in the spotlight. Your questions to Gordon Reid are next. He'll take your questions on U.S. equities right after this. Okay, let's get the questions going to Gordon Reid. We'll go to the email inbox first of all. Our viewer Russ has written us a message. Russ writes as follows: I'm down 20% in Alphabet. Do you see it recovering in 2025? What is your outlook for Alphabet?
I see it recovering. Whether it recovers in 2025, of course, is largely reliant on what the rest of the market does. There's going to be an association between market moves and the company move. That said, Alphabet's business plan is changing. AI is really taking over from the search model that we knew in the past and which Google dominated with mid-90s% domination. That's changing, and I think the market is sort of reacting negatively because they see that that number is going to decline. They will have their share in search through AI. How much? We don't know yet, but they'll have a piece of it. But I think the interesting thing about Alphabet is that they've got other initiatives that are real moneymakers. YouTube is a juggernaut, 2.49 billion monthly average users. 47% of people who use the internet go to YouTube once a month or more. So the numbers are startling, and they have monetized it, but it's early days. There's a lot more runway right there. The autonomous vehicle market with Waymo is in its infancy and will be a huge moneymaker for Google. So I think there's other initiatives, although I think they'll keep a piece of that legacy search business. But given its valuation, which is in the mid-teens to high teens price to earnings, I think it's a very good hold.
Okay, thanks for that initial question. Let's go to the phones for the first time in this program. Jim is on the line. Jim, thank you for calling us. What's your question to Gordon Reid?
Yes, good afternoon. Gordon, I know you've always been a big proponent of Visa. When you look at the recent pullback here, have any of the other similar companies, such as a MasterCard or an Amex, come into focus for you? Would you hold, two of the same type companies in your portfolio, or is this a Visa every day, all day for you?
Well, we have in our past owned MasterCard, but that goes back quite a number of years. Visa has been our favorite for quite a few years, partly on valuation because it trades a few multiple points cheaper than MasterCard, partly on the fact that their debit card business is a faster grower than MasterCard's, and that is a bigger part of the payment system as time goes on, and partly because after buying back or reacquiring their Visa Europe business, they've got greater European or international tentacles. So all in all, we tend to favor Visa over the other payment methods.
Okay, thanks for that call. Let's go to Rick in Vancouver. Hi, Rick.
Hello, Gordon. My question is on Merck.
Yeah.
I bought it a few months ago, and it's down considerably, and it was actually trending downward even before this latest batch of tariffs. So can you tell me, would you recommend that I hold on to it or even possibly add to my position here? Okay, thank you. Have a good day.
Sure, Rick. I'm not going to comment on whether you should add to your position without knowing, the whole structure of your portfolio. But I will comment on Merck itself. The whole healthcare complex was weak in 2023 and 2024, which meant it came into 2025 as one of the very few groups that actually traded at a very reasonable multiple against its history. What we're faced with now is the systemic fall of the market combined with, and it's been in the news today, the threat of even more tariffs, this time on pharmaceuticals. And even though Merck has made a number of initiatives to bring home or bring back to the United States production facilities, they've invested, I think it's over $8 billion in the recent years. And they have another initiative in North Carolina of over $1 billion. You just don't know where this is all going to end up. I will say that the drug pipeline that Merck has is particularly exciting. They've got something in the order of 60 drugs in phase 2 and phase 3. Keytruda, which is the oncology drug that they're best known for, is a miracle drug. It's proving to be or have efficacy in areas outside of the original target, which we're seeing a lot of, which is also encouraging. So I think all in all, it's a good piece of a portfolio. I can't tell you when it's going to turn, but I think it's a good component of a diversified portfolio.
Okay, thanks for the question. Let's move on to Bowmanville, Ontario. Bill's on the line. Hi, Bill.
Thank you for taking my call. Gordon, is it time to buy Eaton, or is there something else in that sector you like better?
Yeah, Eaton's exciting. It's of course an industrial and the electrical division of this company is key in the development and building of data centers. There's been a lot of debate over whether the industry got ahead of themselves in terms of building these data centers, whether new technologies are going to overcome and make them obsolete almost before they're up and running. But I think that my own view is that Eaton has a place in this industry. I'm encouraged by the fact that it's trading at a lower valuation than it was. We owned Eaton in the past, and you could see with the run-up that obviously was a hindrance to the multiple, and we sold it when it got to, I think, 33 times earnings, which we just thought was too rich. And it's now down considerably from that in terms of valuation. So certainly I would look at it as a good component.
Okay. Thanks for that first group of questioners. We'll be back with Gordon right after this. He's president and CEO of Goodreid Investment Counsel. He'll resume taking your questions on U.S. stocks. Our number is 1-855-326-6266. The email address is marketcall@bnnbloomberg.ca. Okay, let's keep the questions coming to Gordon Reid. Arthur is in New Waterford, Nova Scotia. Arthur, thank you for your call.
Good afternoon, gentlemen. I just wanted your opinion, Gordon, on Pfizer and is the dividend safe? I think it's around 8% today.
Yeah. I think the dividend is probably challenged. I think it's safe. So it's a discretionary decision on the company's part as to whether or how they allocate capital. The company itself, I think the bottom line is that there are better opportunities in the pharma space. I talked about Merck in the last session, and I think that is a better opportunity. If you look at Pfizer and all of the money that they've spent on acquisitions, and it's tens of billions of dollars, and they really haven't gained anything out of it. They're not growing, and any sustenance of their bottom line comes from cost cutting. So they're really challenged, and it's a shame because they really did a good job at time of COVID and the pandemic, and the run up was obvious in 2021. But it's been downhill since, and their pipeline isn't that strong. So I would pass on Pfizer and look for other options.
Okay. Thanks for the question, Arthur, from New Waterford, Nova Scotia. John is in Vancouver. John, thank you for your call.
Oh, yes. Gordon, I'd like to know your thoughts on Boeing. I'm heavily invested in this stock. It's gone down a lot in the last year, but they've built some great planes over the last 100 years. So I'd like your thoughts on this.
Well, they have, John, but I think that with clear eyes, we have to see that their reputation has fallen. Mostly because of the 737 MAX situation, and not only the fact that they lost some airplanes and tragically passengers, but how they handled it as a management group. They've had management shakeups, and so from a reputational standpoint, they aren't the Boeing of 20 and 30 years ago. They also have cash flow issues where they are struggling to get anywhere close to where they were pre-pandemic from a cash flow generation standpoint. And finally, with all of the angst in the world between nations, particularly China, we have to ask, how firm is their international business from international customers? And I don't have the answer, but I think it's something to consider. So for us, it's just not a company that's compelling enough. So we would pass.
Okay. Thanks, John, for your call. Al is in Manotick, Ontario. Al, thank you very much for your call. What is your question to Gordon Reid?
Yeah, good afternoon, gentlemen. Mr. Reid, I called in a couple of months ago when you were on. I asked about Uber Technologies. Mm-hmm. You really liked it at the time.
Yes.
Excuse the pun, but it's been a really rough ride since then. What do you think now? Thanks a lot.
Well, it has been a rough ride, but it's been a rough ride along with the market. And I think if you looked at Uber against the market, it's done all right. And I think it's a good component of a portfolio given all of the tariff situations. Part of Uber's issue is that the market looks at autonomous driving and autonomous vehicles as a binary issue where you're going to have a winner and a loser. And there's been some thought that Tesla would overtake Uber because Uber couldn't compete in an autonomous vehicle market. I would challenge that. And in fact, I wrote a blog about 2 weeks ago that's on our website, goodreid.com. If you go to the Insights and Articles area, you'll see that blog on Uber. And I identify the fact that Uber is in that business. They are working with Waymo. They've got a real capital commitment to the autonomous vehicle business. And the financial opportunities are great. One statistic that stuck with me was that a driverless autonomous vehicle, obviously driverless, cost is about $1 per mile, which is half of what you would pay if you had a driver in that car. The other thing to consider is the use of that capital. So a car can be used 24/7, mm-hmm. Yet, of course, we know that with a driver, it's often sitting without producing any revenue.
Thanks a lot for your call on Uber from Al in Manotick, Ontario. Let's go to Dominic. Dominic's in Montreal. Dominic, thanks for your call.
Yes, hello. Thank you very much for taking my call. I'm looking for growth at a really good price, and I know that JP Morgan is a good quality stock, but I wonder if Gordon sees double-digit growth from this entry point, and what a fair market price-earning ratio would be for a stock like JP Morgan.
Right. Well, I think, first of all, Dominic, that the financial sector offers great promise. It's reacted to this tariff issue on the side of, well, what happens if there's a recession? So slower economic growth, obviously not good for banks. But I think absent a recession, that is, people come to their senses, there's deals done, confidence increases in the economy, and banks get back to what they do, best, and that is lend. You're going to have a very good opportunity in the banking sector. To say nothing about the regulatory area, the backup, huge backup in M&A deals, mm-hmm. capital markets business, mm-hmm. that it's just going to play right into these banks mm-hmm. if we don't have a recession. So you make your choice here, and JP Morgan is a good option. I wouldn't value it on a price to earnings basis. I'd value it more on a price to book basis. It's expensive, pushing say 1.8 times book. It's hit 2, a little over 2, but that's expensive. Other options that are less expensive, Bank of America, and then way down the scale, Citigroup. I think if we skirt this recessionary area, you'll probably have better opportunities for capital appreciation lower down the food chain in the cities and Bank of America's than you will in JP Morgan.
On the M&A topic, there was great optimism when Trump was elected that regulations would be loosened and ignite a wave of M&A. Do you think that story is still there? It's just been buried by the trade situation for the time being?
You know, I do.
Right.
I think that's the second wave of Trumpism 2.0. I think he wants to take care of tariffs. Then he wants to give people a big tax break, even though they're going to be paying more in tax through the tariffs, but that'll be his, that's again his playbook. But the other side of it is he'll reduce regulatory burdens on companies. And from what I'm hearing and from industry people, the M&A pipeline is full, especially on the higher end. If you go to over $1 billion of market cap, there's a lot of deals either being done or being contemplated. Within our own U.S. small cap portfolio, which is 35 names, in 2025, we've already had 2 takeovers. I don't think we had one in 2024 or 2023 because of regulation. So there's good opportunity here. And in the smaller group, there's nervousness. So smaller companies are nervous, sitting on their hands. They want to do something, but they want a clearer sight before they do it.
That's Gordon Reid and his take on the U.S. financials in response to a question on J.P. Morgan Chase. We'll take another break. When we come back, it'll be time to take a look at Gordon Reid's past picks. Welcome back to Market Call. Thank you, as always, for being here with us. Time now to look at Gordon Reid's past picks. Gordon was with us on April the 17th of 2024, so about a year ago. One of the stocks he recommended on that day, he just spoke about it briefly. He'll expand on it now. Bank of America, total return over that period of time, -3%, affected, of course, by the recent plunge in the equity markets.
Yeah. Round trip here. It was trading in the mid-40s and doing quite well. And we think it'll go back. From my previous comments, you know that I'm positive on the financial sector, the money center banks in particular. A few things that are happening here that I didn't mention in the past segment. One is that the yield curve is starting to normalize. So we're seeing a steepening yield curve, which is positive for banks just lending and using their assets efficiently. I mentioned the capital markets, which is an important aspect for Bank of America. So we think that all in all, these banks are a good sector to position yourself in. And listen, even if we go into a recession, and I know a lot of people out there might shudder at that. Yes, markets go down during a recession, but I've lived through many of them, and I've been invested fully through many of them. And it's just keeping your head about you, letting time work for you. What a lot of people don't know is that event-driven recessions, not economic cyclical recessions, tend to be shorter and shallower. Right. That when you go through a recession, at about the halfway point of the recession, the market, being a forward-looking indicator, starts to move up. Right. So they don't last as long and aren't as hurtful as one might think. But top to bottom, they can hurt, but you don't spend a lot of time at the bottom. Okay. Chevron is number 2, a big player in the energy sector, of course. CVX in New York, total return here -10%. Yeah, we sold our CVX in around the 140, high 140s. With the Hess deal that was being contested, it just got too murky. We felt that we had good representation in the oil field with our Canadian portfolio, where we own both the integrateds and the E&Ps, and we own some natural gas. So we were comfortable with that and decided to move away from Chevron. Look at the massive drop in that stock very, very recently. Okay, let's go to Dycom now, ticker symbol DY in New York. This is a provider of services to the telco and infrastructure industry. Yeah, they're benefiting from the fairly large $40 billion carve-out of the infrastructure bill that is intended to bring the internet to rural America. And they're taking 1 gigabit technology and basically doing the pick and shovel work, digging trenches and laying fiber. They are lumpy, and the reason for that is that they have relatively few, say 8 or 10 customers who make up 80% of their total revenue. Those customers would include the big telcos like Verizon and AT&T and mobile. Also, Google is a very big customer. But if one or more of them defer a capital decision, it shows on DICOM's financials. So this is one, if you're going to buy, be patient with it because it will bounce around. It's a high beta stock, but it also has great opportunity. They've got about 1.5 years of backlog on the books, so on their order book.
Those are Gordon Reid's past picks from about a year ago: Bank of America, Chevron, and DICOM. Well, on a quick programming note, please join us tomorrow on BNN Bloomberg for the launch of a special feature designed for Canadian investors interested in options. We'll dive deeply into the world of options trading, exploring the fundamentals of puts and calls and other instruments and how you can effectively use them as tools in your portfolio and manage risk. It's a special that will run every 2 weeks, starting tomorrow, April the 10th, at 10 a.m. Eastern Time, 8 a.m. Pacific Time, with Chris Tom. He's an expert on options from Moat Financial, and he'll be our guest on Know Your Options, coming up tomorrow at 11 a.m. Eastern, 8 a.m. Pacific. In the meantime, we will be back with Gordon Reid, President and CEO of Goodreid Investment Counsel, right after this. U.S. stocks are in focus. Welcome back. Let's keep the questions coming to Gordon Reid. Our next caller is Mario from Vaudreuil, Quebec, just outside of Montreal. Mario, thanks for your call. What's your question to Gordon?
Hi, good afternoon. My question is on Tesla. I was just wondering if it's a buy, because I was a little nervous about the sales, like if this year, like they haven't announced what's been going on, so I was just wondering if I should get in or get out, actually, also.
Yeah, Mario, we've never been an owner of Tesla. The argument has always been whether it's been valued as a car company or a technology company. As a car company, it didn't make any sense to pay the types of prices that the stock was demanding. A few things happening with the company. Of course, Elon Musk is in the news big time, and he's not gaining any friends. A lot of international blowback against Tesla and against Musk and some of the things that he's been saying. So that, from that standpoint, there's been reputational risk. And we're also seeing it on the sales side. The sales numbers have been weak. So what it really demands of an investor is that you more and more place your faith on the technology side of what Tesla can bring, battery technology, whether they can stay ahead, whether they can come up with new technologies. Just not a space that I'm comfortable with, and also not comfortable with personalities like Mr. Musk.
Okay. Let's go to our next caller. Thanks, Mario, for your call on that stock, on Tesla. Let's go to Tony in Waterloo. Tony, what's your question to Gordon Reid?
Yes, good afternoon. I've been eyeing Intel for the longest time, and I was wondering, at these levels, would you recommend buying it? And I guess just off topic here, if this trade war lasts any more than 6 months, would you agree we will have a recession? But I think it's going to be settled well before that. And also, I think the reason why Trump is not insulting Canada anymore is because Trudeau's no longer in office. So hopefully things will stabilize for our countries, and hopefully you will honor the USMCA deal. Thank you very much.
Thank you.
Thank you. Yeah, you make some excellent points. I think that on Intel, there's lots of opportunity in the tech space. This is one where you're really taking a leap. They just haven't executed. either in terms of delivery or timing. And those are two big strikes. They've gone through a lot of C-suite changes, which is always a little bit disturbing. We're hearing a lot about people coming in or groups coming in and teaming up and taking technology, basically buying the company up piecemeal for their technology. It's a bit of a swing for the fences type of situation. Could you hit a home run? Certainly, it's happened before. But as a piece of a long-term investment portfolio, I think there's areas within technology that offer greater certainty and greater opportunity, to be honest. So I would go with those.
Okay, thanks, Tony. Let's go to Sal in Toronto. Sal, thanks very much for calling. What's your question to Gordon?
Hi, thank you. My question is on Adobe. I was interested to know, do you think right now is a good time to enter a position into Adobe, given it seems to have a good balance sheet and seems to have a lot of fiscal firepower if it's needed to sustain the downward momentum? On the other hand, though, I do see a growing anti-U.S. movement. So I was just wondering, do you think that could have any impact on a business like this if populations were turning away from U.S. products, and could Adobe be in the crossfire? Thanks so much.
Okay, well, good question. I think you should always ask those questions. I don't think that Adobe is the type of company that would suffer from an anti-American sentiment. I think those would be more consumer products, more products off the shelf. As far as Adobe, we owned Adobe in the past and did actually very well with it on behalf of our clients. We saw the introduction of AI, but as that matured, what was exciting to us at the beginning and to the market, to be frank, was that using AI, Adobe's capabilities were enhanced. And what that morphed into was perhaps they could be made obsolete. So the great technology that Adobe has brought to the world with AI might just be what every school kid can do in completing their homework. So we exited, and I see no reason to get back in at this point. I think that issue is still lingering with me.
Okay, thanks for that question on Adobe. Here comes an email message from one of our viewers, an email question. Glenn writes as follows: can I get Gordon's thoughts on Mercado Libre? Thank you.
Yeah, this is a South American version of Amazon, I guess. It would be the best comparison. Couple of differences. One is that the South American market is underpenetrated. Demographics are very, very favorable in South America. The population tends to be much younger, much more active on internet and e-commerce sites. They're growing very rapidly, and they're not that expensive. So this is a company, I don't often do this, but this is a company that's been on my radar, and I'm continuing to look at it. We don't own it at this point, but I think that it provides, further work, and it's certainly an interesting company.
There you go. Thanks for the question on Mercado Libre from our viewer, Glenn. We will take another break, and as we come back, Gordon Reid will continue taking your questions on U.S. stocks. Okay, let's keep the questions coming to Gordon Reid. Ryan is a viewer in Toronto. He's written us an email. Can I please get Gordon's opinion on CAT? That's Caterpillar.
Yeah, Caterpillar has had a bit of a rough go over the last while. One of the things that's going in their favor is that about 50% of their domestic production, or their production, is domestic in the United States. So it's out of the target that we see with the Trump tariff issue. 35% of their business is service business, which is recurring, which is encouraging. I think it's when you look at the international business that you start to have some questions. One of those things where we've talked about it all show is if there's a recession, if the tariffs aren't negotiated successfully, CAT's going to be in some trouble. If there's not, this might be a very good entry point for CAT. The infrastructure situation in the United States really hasn't changed. Administration has changed, but there's still strong needs for roads and bridges and renewal of infrastructure in the United States, and I see no reason that won't continue. So depending on your view, or if you want to put it in a portfolio and have sort of a barbell of those companies that are reliant on there being no recession to do well, they'll do very well if there's not, and then take some cover in some other areas of more defensive, true domestic situations, utilities, telcos, consumer durables, staples, that type of thing. That's not a bad thing to do either if you're building a portfolio.
Okay, thanks for that question on that stock. Let's go to Stu now. Stu's also writing us by email, may I please have Gordon's opinion on BlackRock as a long-term hold?
As a long-term hold, I like it. It's a bit of a proxy for the market. They've got, I think, over 10 trillion, may not be 10 trillion now, but they were around $10 trillion of assets, of AUM, assets under administration. They're a good operator. They're not a cheap company. They traded about 17 times earnings, which these days is about a market multiple. But you can see they've traded off from over $1,000 to where they are today. So they've come down with the market, and I think they're a good proxy for the market. So if you're looking for a hole there, then I'd definitely buy them.
Okay. Here comes another email question. Ellen has written us this question. My question for Mr. Reid is regarding Home Depot. I hold this stock, and I would like to know what your outlook for it is.
We're not a buyer at this point. The consumer is still very weak. Year over year, organic growth of revenues is negative. They're still trading at a fairly hefty premium to both their historical valuation levels and to the market. I'd rather see a stronger consumer and them turning the corner. So that would mean a stronger housing market, and I'd look at Home Depot or Lowe's. We always do peer group analysis, as you know, Paul, and I haven't done any work on this group in the last few weeks, but Lowe's was always the company that came out on top for us, largely because of the valuation differential between them and Home Depot, and the fact that really they borrowed Home Depot's business plan through management movements from Home Depot over to Lowe's,
right?
and just re-employed them, and given you can get it more cheaply, just made more sense.
Okay. Let's squeeze in one more question before we take a break and then move on to Gordon's top picks. AJ in Vancouver has written as follows. I would like your opinion, please, on Kraft Heinz.
Yeah, well, Kraft Heinz is a company that does give you some cover. They split, I guess, 10 years ago, was it, Paul? I don't know. They split the company up, and Mondelez took
that was a very unsuccessful merger, was it not?
Well, Kraft split out and took their sugary snack business and split it into Mondelez.
That's a different transaction, I think.
And Kraft Heinz got together.
Right.
And I think that maybe tells us there's something in this, that these companies in this industry have to get together because there's not a lot of organic growth there. And you can see from the chart that it's very, very lumpy. It will give you some cover from the tariff situation, but on the other side of it, as a food company, you are faced with changing food habits. And I'll point to GLP-1 and the weight loss drugs out there that are starting to have a real effect on the sales of certain food types.
That is Gordon Reid, and that's all the time we have, unfortunately, for questions today. Thank you to everybody who called in or wrote a question, and if you didn't do so today, please do it the next time on Market Call. Don't go away just yet, however. Gordon Reid's top picks are around the corner. Please join us tomorrow on Market Call. Stan Wong will be here. He's portfolio manager at Scotia Wealth Management, and we'll take your questions on North American large cap stocks and exchange traded funds, ETFs. And if you miss an episode of Market Call, check out our daily podcast. You can hear it on iHeartRadio and other platforms. You can also watch full episodes, on our YouTube channel. Okay, time now for past picks on Market Call with our guest, Gordon Reid. Number one, the giant of the copper-producing world, Freeport-McMoran, FCX in New York.
Right, and this is a stock that's taken a big hit. We've seen a divergence between copper prices and the company's performance. Part of it was technical, with copper prices moving pre-tariff to over $5 because of front running on the accumulation of copper. It's settled right now back into the low fours the last I looked. But you can see that Freeport has dropped into the 20s. And from my standpoint, this is a generational opportunity to buy a company like this at these levels. It's a fluid situation by any measure, but secularly, copper is intact. We're using more and more copper products for electrification in our everyday lives, in our technology, to build cars, to build data centers. Its usage of copper is increasing. The last I looked through over the next 10 years, they figure that by they, I mean the street analysts, are looking at a compound growth rate of probably 2 to 3 times GDP, so in the 7 to 8% range, which is very, very bullish. On the negative side, 50% of copper is used by China. So we've talked a lot about tariffs, we've talked a lot about the angst in the world. If it's not sorted out, something's got to give, because they have to get their copper somewhere. So I honestly don't know how that's going to sort out. What I know is that it's not easy to bring mines on quickly, and long term there's secular tailwinds. So given the prices today, this seems like a pretty good risk reward. Just finally, we are so bullish on copper that I recently put Teck Resources, a Canadian company, into our Canadian portfolio. So that's now there as well.
Okay, so you own both Teck Resources and Freeport-McMoran. Number two, we go to the tech sector, Meta Platforms, META, of course, on the NASDAQ.
Yeah, Meta has had its ups and downs over the years. The metaverse was a chapter in their life that not many people, including ourselves, understood. But they're back doing good things. Like almost every chart that you see, it's taken its lumps over the last little while. But when you ask yourself the serious question, how are tariffs going to affect Meta and social media? Well, there's going to be things around the edges, but not the core issues. 1 in 2 people are a user of a Meta product every single day. Right. 1 out of 2 people in the world. Yeah. So over 3 billion people, which is astounding. And that is just a money machine. They don't trade at a very challenging multiple, and they seem to have their management issues somewhat contained. Regulatory issues are always going to come up with Meta. Interestingly, when the EU announced their retaliatory tariffs this morning, they didn't touch the tech companies, the communication services companies, which have always been in the bullseye for the EU. I think that's an interesting tell.
Okay, Meta's number 2, the final top pick on this day, Morgan Stanley. Back we go to Wall Street, MS, ticker symbol MS in New York.
Yeah, given my strong comments on JP Morgan and Bank of America and Citi, I couldn't let the top picks go without putting in a Wall Street firm. They're a bit of a hybrid. They are a money center bank, but they're also a wealth management company. They've accumulated companies over the years. They bought Eaton Vance, they bought E-Trade. So wealth management represents about 50% of their total revenue, maybe a little bit more. Ted Pick is the new CEO. He took over from James Gorman, and he's been a long-time Morgan Stanley employee, an executive. So I think coming out of this, they'll do well. They've traded off to what is, on an historical basis, compelling valuation. So I think we would do well with them.
Gordon, as always, thanks very much.
Thank you, Paul.
Thanks to Gordon Reid for being our guest for the umpteenth time, more than umpteenth time here on Market Call. And in particular, thanks to the viewers who took the time out of their day to ask a question of our expert guest. Quickly, let's take a look at markets. We're all wondering what the state of the markets is. There is an up day, a pronounced up day on Wall Street, with the NASDAQ composite up by 2%, the S&P 500 up by more than 1%, and the S&P TSX composite down by 0.25 percentage point. Let's check in on the price of gold. It is a likely bright spot in today's markets. And if we can, there's gold up 4%. So what's happening to Barrick Gold, ticker symbol ABX? We'll take a look at Barrick, and then we will move on to other programming here on BNN Bloomberg. There's Barrick Gold up by 4.5%. Thanks for watching Market Call. Stick with us here on BNN Bloomberg.